Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the Common Sense Investing Show. I'm Victor McClure.
I'm Guy Allard. About 2 seconds ago, our engineer told us both that we're old. But great news, McClure Capital spares no expense on their podcast. We are coming to you live from Davos, Switzerland. What time is it over here, Victor?
I have no idea.
All right, maybe we wish we were in Davos, Switzerland.
I was listening to the news last week. It's like, Trump's in Davos. I'm like, where the hell's Davos? I was thinking, is that in Africa?
The last president that went was Clinton.
Yeah.
They don't all go.
No, it's some kind of summit on trade, right? Trade
Yeah.
summit. I've never heard of it. I've been to Switzerland. I never heard of
A
Davos.
lot of globalism, a lot of, stuff like that.
I was in Lucerne, Switzerland. Got a lake, and oh my gosh, it's the most beautiful place I've ever been. The one thing you got to worry about is the Swiss franc never was the euro, never the dollar. The currency is crazy strong over the years.
Right.
And so when I went to buy a sandwich, in Europe you don't have I don't have my big supersized, like we're Americans. I need supersized fries. I need a big old giant 4-pound hamburger. Well, it's this little bitty sandwich. Looked a little fruity to me. I'm just saying, but the little sandwich, it's like $28. I was like, oh my god,
It's more expensive in England, isn't it?
Way more.
Not as much as Bora Bora.
No, you go to Europe now, the euro, it's close to $1 now. It was up to, when I was in Europe a couple times, it was $1.60, which is expensive. Well, the Swiss franc is probably 5 times higher, in my opinion, than Hawaii, which ain't cheap.
Well, it has a lot to do with trade, too. They talk about the dollar supposedly at some point here is going to start strengthening. It's not there yet, but when it strengthens, it hurts us in trade, right? Right now, when it's a little weaker, it's better. So, it's got that inverse relationship with trade.
Yeah, it's real weird. I did this after I bought the sandwich. I wasn't thinking. This one couple that goes with us sometimes on the trip, we went up to the bar. We were going to get a round of drinks for the 4th.
I remember the couple.
Yeah. And when I got up to the bar, I said, all right, let me have 4. And it was just regular drinks, nothing, it wasn't Johnny Walker Blue or anything, just regular stuff. They gave me the bill. I said, close out the tab because we're going to walk down to this other place in a minute. $240 for 4 drinks.
Was it just no food?
Yeah, no food. That was just drinks. I go,
wow.
Well, I'm not buying every round tonight. Holy moly.
Don't they have free health care for everyone?
Yeah. I'd rather pay my health insurance. That's why we worked at Dillon Gage all those years. My son says, well, Canada's a much better system than America. He's liberal and all that. Much better system. And I go, we have an office in Toronto.
Right.
Office in Toronto, people make like, 50, 60 grand a year. They got like 50% taxes. I asked every one of them, would you rather pay $800 a month for your health insurance or 50% taxes? They go, I'd pay my health insurance in a second.
Yeah,
Are you nuts?
I'm not really versed on Canadian health, but don't you? It seems like most of those, you've got to get in line for treatment. You got to go through an approval process, which can be quite lengthy. And if you've got something terminal and it needs addressed right now, that's just not the program, is it?
No, I think doctors are capitalists. Capitalism works. I don't care what anybody says, it works. We have the best doctors in the world. We've invented more stuff than anybody in the world. Why? Why would we, as an American, one new country, and relatively, right, invent almost everything and do everything like that? It's capitalism. I read a story where a doctor in Cuba makes less than a waiter at a hotel.
Yeah,
Now, does that incentivize you to go to 8 years of medical school?
Exactly.
Right?
Exactly.
No. And so we get the best of the best because they can make money. I don't think money's evil. I don't think making money is evil.
No, it can corrupt people for sure.
I was trying to explain to one of my sons. I said, he goes, why do these basketball players make so much? I go, it's supply and demand. What happens is the fewer people that can do your job, the more you make. So the highest jobs make the most because very few people can do it. It just happens to be sports or something physical.
People, they shun money and they do.
Right.
It's a lot like power. George Bernard Shaw said once that power does not corrupt men. Fools, however, If they get into a position of power, corrupt power.
No, what are you trying to say?
I'm trying to say
Politicians?
power in and of itself, as money in and of itself, is not evil.
Right.
But when fools get both, they can corrupt the use of it.
Well, you said, aren't the richest people the smartest? I go, it has nothing to do with one another.
No.
They can be.
They're usually the hardest working.
Yeah, they
unless
got
it's
other
inherited.
they're good people skills. They got all these kind of things.
Yeah.
They're great salesmen, or whatever it is. But normally the smartest people are like engineers, some scientists, and they're working for some big company or something. They're not rich at any stretch. Don't get me wrong, they're great savers, very plotting, and they end up with quite a bit for what they make. No question. But I go, no, I'm trying to teach them to get some communication skills, the thing that we lack in our young people with the Twitter and the texting and all that.
Well, and he's at the age now in his mid-30s. He didn't have all of the smartphones to the extent that kids do now. He didn't have it as young as the kids do now, so it's even worse now, don't you think, than for him?
These kids don't commute. They'll be sitting right next to each other, texting each other. I had my 15-year-old with three of his friends.
That makes no
They're in
sense.
my media room.
Right?
Now they're spending the night. 3 friends in a media room. TV's off. Now they're texting each other. They're sitting next to each other.
Instead of talking?
Yeah. I mean, that doesn't make any damn sense.
They probably have a few other people on the text, though, I would imagine, but still.
Oh, there's no telling.
point's
I'm glad
the
I
same.
didn't get that text. I'm no telling what was on it.
Don't you go and look into your son's phone and see what he's texting?
Oh, yes, as a good parent, I always do. No.
You monitor it.
No. All right.
All right.
Well, let's talk about this. If you've heard this show, we've been doing this show for, 20-something years. What I've always tried to tell you is you got to think outside the box sometimes. The problem with traditional investing, with just stocks and bonds, is we get locked up into it and we don't see that there's alternatives that can make it safer, give us a better yield or whatever. And so we've talked about bonds right now. There's an issue I have with bonds, and it's not just me. Anybody should have with bonds. They're not rewarding us for the risk we're taking. What happens is if interest rates go up, bonds go down, right? And so if I've got an average 10-year bond right now making 3%, I think the government bond just ticked up on 10-year. I think it's like 2.4, 2.6, which is pretty good for, I can't believe I'm saying that. It's average 7 or 8, by the way, for like 100 years.
I know, but,
but lately,
right now it's pretty good.
Right.
That's right.
So if they're only going to give me 3, if I sell it a day early, I can lose money if interest rates go up, right? Well, that's not much reward. So basically they're telling me I can lose money. At the high side, I can make 3. Because most of the bond yields on like funds and stuff have been the capital gain of the bond. In other words, interest rates went down, so I got some capital gain and the interest. Well, since interest rates got to the bottom and they're starting to creep up, it's impossible to get capital gain. You might have a capital loss to deal with. You're still going to get, but the only interest you're getting is, say, 2 or 3%.
That's right.
Well, 2 or 3% is not me willing to risk my money, especially if you buy a high-yield bond fund. You could lose 20 or 30% on a high-yield bond fund, and you might be getting more than 2 or 3, might get 3 or 4.
That's right.
But that's getting ridiculous. The risk-reward ratio is not there. If I can make, like the stocks, I like stocks. You can make 20 or 30, right? Lose 20 or 30 in a year, whatever. But at least it's even.
There's a technical term, and I always do this on the radio. I don't know if it comes across right, but it's called the efficient frontier. Right. And if you picture an L, the vertical line is your rate of return. Starts at 0, where the bottom of the L, and it goes up to 5, 10, 15, 20. And then the horizontal part of the L, starting from where it joins, is standard deviation or risk, what Victor's talking about, how much it fluctuates. From 5, does it fluctuate 5%, 10%, 15, 20% a year? Well, the best rate of return, if you were going to put a dot on that L, would be on the vertical line at 20%, right? No risk. It's not going out to the right, and you're getting all of the return. So what Victor's saying, if you were to chart this, and you'd put that dot, so you go up the vertical 2 points, which is not very high on a 20 or 30% chart, but then you've got to take it to the left quite a bit. The right. To the right farther. The farther right you go, the more risk for only 2%.
Right. It just doesn't make sense. So, but it also doesn't make sense that we're 8 years into a bull market. There's never been an 8 in history, or a 9, or a 10. PE ratio, the forward-looking PE is like 28, 29, and that's historically 14. The Shiller PE ratio, which is more used nowadays, is 32 when it's normally 15 or 16. So the stocks are, no matter which way you look at it, are double valued what they should be. So having 100% stocks is not the answer either. You still need to have like a stock and bond portfolio or stock and something. And so what I've discussed in this radio for all these years is look at an index annuity instead of your bond or a portion of your bond allocation. Because remember, the bonds have risk, more risk than they've had because we've been going down in interest rates for 30 years. They've had more risk than we've had in 30 years in bonds right now. So instead of using those where I've got risk and I'm not getting a reward, have one that doesn't have any interest rate risk and makes more in this interest rate environment, and probably the environment we're going to be in for at least 10 years. And so I've said all that stuff, and I don't know why everybody just doesn't believe what I say, but now Roger Ibbotson has done a detailed study on it. He's a Yale professor. He's also, if you ever gone to a brokerage firm over the last 100 years, you see this big old chart, and it shows you if you had $1 in bonds for the last 100 years, it's worth $40 or $100. That's pretty good. It's 100 times your money. If you had it in this, it'd be this. Corporate bonds would be this. And if you have it in stocks, it'd be worth 5,500.
Right.
So, 50,000% difference, right? So it shows you being in stocks. Well, he's the one that started those. Ibbotson charts is what they're called. And so this is a person showing you the value of being in stocks. So this isn't some pro annuity guy, right? This is a pro stock guy. What he's saying is logically, the risk in bonds right now makes sense to look at alternatives for fixed income.
And we've said this a lot if you've listened to the last several podcasts and to our radio show, but it's really important, and we'll probably continue to do so just to combat all the negative or subjective viewpoints that you're going to get. Victor and I both started doing these equity index annuities. The acronym is EIA in 95, 96 when Safeco came out with the first one, and are probably two of the, you hate to pat yourself on the back, but most knowledgeable on these because we've seen them from their infancy and we've used them successfully. But you get so much negative press on it that is not accurate. This Ibbotson report, and I'm sure Victor will offer it to you if you're interested to call us or email us. We'll be happy to send a copy to you. But it goes through, and we'll go through it with you. And it'll probably take a couple podcasts to get through it all, but it shows graph after graph of the fixed annuity versus bonds, a portfolio that's 100% of this, or 60-40, or 60-20-20, and it shows you. We also always talk about the hardest thing to do is to reallocate and adjust your portfolio when it's doing so well. The market's so hot, every single month it goes up, and it's making new highs. Your accounts, your 401k accounts right now, have probably gone up enough, and I'm just speculating here, they've probably gone up enough where you could take out X amount of dollars, secure your income, and still had what you had before and continue to go forward. But holy cow, it's against your nature. You just don't do it. It's too hot. Oh, it's going to go up one more. Let me wait one more year. It's going to go up one more year. I can't do it.
I've heard that probably 20 times in the last 30 days. Your plan is logical. That's absolutely what I'm going to do. But I'm going to wait 4 more months, 6 more months, 1 more year. It's all the same.
Right.
Because everybody's got to get that last piece. But remember to distinguish advice. If somebody's selling a competing product, don't listen to them.
Absolutely.
If I'm a pro annuity guy and I hate the stock market, if I say the stock market is a casino, I'm not telling the truth. All I'm doing is trying to sell an annuity. Just like the stock market guy that says the annuity's terrible, the devil's work, you can always do something better with an annuity. They're selling a competing product. For every person that does that you read, every person, I'll give you a Nobel Prize winner in economics or an Ivy League professor that says they're wrong.
And the problem is they're successful and they're rich beyond means, and so you think, oh my gosh, this guy's got to know what he's doing.
They're just selling something different.
That's right, and very good at selling it.
And that's why a lot of our clients have come to us, and a lot of them, I've got kudos on our show for many years saying, hey, you guys do everything, so you're not biased either way. We are compensated on stocks, bonds, everything. I go, but if you're just logically looking at just the math, right now, I would take an index annuity over. The average is 4, 5, 6%. You're making more. You have no interest rate risk. They're just a better deal right now. When bonds start paying 6, 7, 8% again, which they may, I don't know, but if they do, now they're rewarding me for it, and I might get some capital gain stuff because interest rates have obviously gone up, right? So if they go down, I'm going to get capital gains and the interest rate. Now they look good again. not put the index annuities in the allocation. I'd go back and put bonds. But for the next 10 years, there is no way you're going to make more than 3 or 4% on a bond.
You know, each one of us will read this report, and again, it's available to you. We'll share a number.
Yeah, give me a number.
972-715.
2424.
I haven't done it in a while. I forgot it.
It's 972-715-2424. You can go to ilovemyretirement.com.
One of the nuggets I got from this, and like I said, everyone's going to read it and they're going to gravitate to what interests them. But one of the things, you know, you've heard us talk about the stock market prior to adding in last year. From 2000 forward, it averaged 4%, including dividends, if you could find a place to put your money where you didn't pay any fees, which is relatively impossible. With last year, it's now bumped up to 5.3 or something, 5.3%. And you wonder, well, you know, everyone uses that 10% number, 12% number. That's what I've heard. If I'm in it long term, if you look at the charts, Ibison charts, it shows a bigger number. But what these charts and what this report shows, and we've talked about it, dividends used to be great in the 60s. And companies have gotten away. They've shrunk. Oil certainly has lately. We've talked about that because of the price. And that was half of that 10%.
That's right.
And that's why we're at 5 now instead of 10. Now, if we were getting 5% dividends on most of the stocks and we're in the index, you'd be at 10 for the last 17 years. But we're not. It was just one little nugget.
Right.
And you're probably counting on it, and you're just not getting it.
I've talked about that a lot. There's a capital gain portion of your stock market return, and there's an income portion from dividend.
Right.
And in the old days, you're right. I always said maybe it was half. Well, here's the actual numbers. The capital gain portion for the last 90 years has made about 5.8%. The income portion is about 4.18%. So about 40% of the return has been dividends. The problem is we're only getting 1.5%, 2% dividends now. So if you're getting that same capital gain, in a good market, you're only earning 7%. And so you got to keep that in mind. Even with the 20% up year last year, which was phenomenal, I'd like to see one pundit that thought Trump would get elected and the market would go up. I could find you 99 that said it was going the other way.
That's right.
But nobody would get. But even with that, you still only had a 5% return with no fees, no nothing in the last. Now, if you had a 50-50 portfolio, you didn't make 5.
That's right.
Because your fixed income, like your money market, didn't make anything.
And you should have had some variation of that.
That's right. So all we're saying is, since you have the logical thing to do is not to have 100% stocks into an 8-year bull market. I understand people do. I understand people had 90% tech
but
stocks
Victor,
in 1999.
everyone says it's going to last another year.
Oh, yeah. Another 2 years. Remember, there could be 20 things. Our human nature only gravitates towards things that we agree with or trying to confirm what we think. And so you can hear 20. No, I've listened to several people saying the market's going to keep going for a while. I go, but I've heard several that went the other way.
Yep.
No, it's overvalued. You look at the PE ratio every time it's got this high. It didn't go down immediately every time, but every time it went down 50% or 30%. It's nasty numbers every time the PE gets to a certain number. Like one time in the 90s, it just went so crazy. You had PEs and 500 just for temporarily. Just really crazy.
Remember just before 2000.
Oh yeah,
especially with the Nasdaq and all the techs.
Right. So always remember, like long-term government bonds have made like the same 10% or 9%, right? But their income was 5%. Their capital gain might have been 0.3 up to 3. So part of their return was that. Over the last 10 years, it's been about 3% capital gain, 3% income. But remember, as interest rates go up, it's impossible to get a capital gain.
Yeah, but
You're going to get a loss and minus the income.
Yeah, they didn't make 10%. It was like 5.5 versus 6.5.
Right.
Yeah.
When you start adding that stuff together, bonds right now don't make sense. And so, like I said, we talk about this, but it's hard. It's easier when you see it in writing. You see it from an Ivy League professor instead of me, here in Frisco. But it makes sense. This is the numbers I've ran. It confirms everything we talked about for all these years, that you need to look at something else besides a bond right now. As soon as interest rates hit the bottom, I said, bonds are no good now. But they did okay, but you're making 1 or 2%. Why am I going to make 1, 2, 3% when I have risk in it? Remember, there's only one reason in the world to buy stocks, because you want more potential gain than a CD. That's the only reason.
An inflation hedge.
Yeah, you can say everything else. Oh, it's because of this. You want to beat a CD, otherwise you'd have all your money in a CD.
That's correct.
Right? but you're willing to assume some risk for that return. Same thing with bonds. You've got to be willing to assume a risk for return. But when I have a maximum 3-4% I can make, why am I assuming risk? You don't have to.
Think about the chart we talked about earlier. Rate of return going up, risk as you go to the right, getting higher, and you're going to put a dot on there. Where are you comfortable? How far to the right in the risk do you want to go? How high do you need to go rate of return? How little risk can you get, and what's the maximum rate of return? That's ideal.
Yeah. You'd be surprised how much stocks have beaten everything. Every single investment long term.
By quite a bit.
That's right. So everybody needs stocks.
But they didn't take a 30% hit when they got to retirement, and,
That's right.
had to eat cat food, as you said.
We talked about the sequence of returns risk. That one's a big one. You can't put all your money in stocks and take money out of it, having to sell stock to pay monthly bills. It does not work. We talked about that before. Today we're just talking about something with a fixed. Let's say if I can have something that makes 4 to 6%, 4 to 7. Sometimes it makes. Last year they made 14, 10. I go, but
and the annuities. They
had
a great year.
But something can make 4 to 7%. No, like I said, no interest rate risk, no market risk. For a bond paying 2 or 3 with interest rate risk, let's assume it's a really safe bond and no default risk. But if it's anything like, if you got a bond fund that's paying you 5% a year, you have a lot of risk in that bond fund. You just don't know it. Because I know what 10-year safe bonds are paying.
And what we do is what Victor just did. Victor mentioned that our clients made somewhere between 8 and 13, 14% last year. Didn't focus on that, didn't concentrate on that and say that that's what we can make, or we can make up to and leave it at that. But he gave you the average. We're looking for 5 to 7. And if you can make 5 to 7 consistent year in and year out while you're saving, you'll be very happy.
Remember, this is your safe bucket. It's not your risk bucket. Your stocks, hopefully, will do better. They haven't done better the last 17 years, but maybe they will. Nobody's saying replace your stocks.
That's right.
I'm saying when you have a 50-50 portfolio, you got to put that 50% in stock. The other 50's got to go somewhere. A bond is just not the best place right now. Money market is fine. There's no risk in it, right? But 0.1%, CD is fine, 1%. So nothing wrong with CD or money market. They're just not paying anything. What I'm suggesting is open your mind and consider a different one, like an index annuity. Place that in front of the bond, and that's what this report does. It shows you historically what would have happened if you did that instead of a bond through every kind of period you can think of.
And we practice this. I had a referral from a client that just talked with earlier this week. She's 73, and we're reallocating because she lost her current broker. The new one came in, was pretty aggressive, and the personalities didn't jive. And my client referred us, so she called. 73. We're going to have 25% in the market because she can. She doesn't have to have, she's got plenty of money. We're going to take 75. You have to have liquidity, which we say is expensive because you don't make that much, but you have to have liquidity. And the rest we're going to make safe for her. She's fine.
Well, I'll give you the total over the years. Like this, they ran it back to 1927 to 2016. Annualized return on large cap stocks, 9.92%. Long-term bonds, 5.32%. Index annuities, 5.81%. And so they're similar on the bond side, just less risk, right?
Right.
The one thing that shocked me a little bit, what's the minimum return over a 3-year return on large cap stocks? Well, losing 27% is the worst it did during that period of time. Long-term bonds over 3 years, the worst it ever did is lost 2.32. The worst an index annuity ever can do is 0. I don't care what happens, index are 0 every time. That's the worst it can ever do is 0. So that was 27% better in stocks and 2% better in bonds. Now, let's go to the maximum. Maximum stocks have ever made 3-year period is 30.76. Bonds made 23.3. Remember, you're getting capital gains plus the interest? That's pretty good on bonds, isn't it?
Yep.
Index annuity, 27.56. Still, that's a 3-year return of 10% a year. So, index annuities beat the bonds and almost made as much as stocks. You got 90% of the stock return during that period without any market risk. That's not bad. That's what I want on my safe side.
Now tell me again, I've got to deviate here. Someone that tells you no matter what you're trying to do with fixed annuities, we can do better with something else. Here's something that has no risks. Max stocks maxed out in a 3-year period at 30.76, call it 31%. And the fixed annuities with no risk, the equity-linked ones, rounded up, did 28. 3% difference with no risk. Think about that chart. Risk and rate of return. Where do you want to be on that chart?
It's just like I said, we're allocating the fixed income portion, the stock and bond portion.
That's right.
And so you can get a lot better return than you could have somewhere else. Then it starts.
So think about it. I'm sorry. I just had a thought, an epiphany. No, but see, so your 50% of your stock portfolio, that 3-year period, makes 31%. Well, guess what? Your 50% of your safe portfolio made 28%. What a great year that is for you. That's a win-win.
That's right. It also tells you what there's the next part of the white paper. And remember, you can get a copy of this white paper. Just call us at 972-715-2424. Again, 972-715-2424. Or you can always go to ilovemyretirement.com. We'd be more than happy to send you, and we can email it to you, send it to you, whatever you'd like. But it's for a numbers nerd like me, this is nirvana because it's confirming what I've been talking about for 10 years.
That's a prerequisite for this job, isn't it?
Yeah. And Guy was talking about the efficient frontier, where on the left side risk and all that kind of stuff. Well, they actually have this on that study, and it's talking about the risk you'd have versus the reward. And if you look at the large cap stocks versus long-term bonds, obviously stocks have the most risk. They're going to have the most down periods, right?
Sure.
Long-term bonds going to have less, but it still has some down periods. Index annuities can't lose money. And so if you look at on their high side, they were higher, and they don't have the risk side. If you compare them directly to a bond, they made as much or more, but never went down. They cannot go down. You cannot have a loss in an index annuity. So right now, it's just a much better place to be than anything else.
You know, Victor, it's going to take us a couple podcasts to get through this report, I think.
What we're going to talk about in next week's show is, okay, everybody kind of understands that interest rates are starting to creep up. So what we're going to do is show you how this allocation, let's say you were a 60-40 stock and bond portfolio. What if we replace 40% of those bonds or half of those bonds, so you'd be 60-20-20, 60% stocks, 20% bonds, 20% index annuities.
Right.
What does that do to your portfolio long term? It should make it safer and increase the return. Also, 60-40 stock bonds, how about 60-40 index annuities? That's even better return, and you have no risk. You reduce your risk and get a better return. The nirvana of investing, right?
And we know through the psychology of investing, it's hard for you to get out of a scalding hot market. But put it in perspective. What if the part you took off the table to do your income made 14% last year and didn't get all 18% of the market? You're not losing that much.
Right. And we're going to show you, okay, if interest rates go up 1% over the next 3 years, what happens? How about if it goes up 2% over the next 3 years? What happens then? Or say 3%, which 3% over 3 years is not that much. It's only 1% a year.
Right.
But we're going to show you the different things. If interest rates go, what happens to a normal stock and bond portfolio? What happens if you replace part of that fixed income? So I'm honestly not even telling you to sell your stocks. I know it's going to be too hard to do it anyway. But what about that bond allocation you've got? Unless you're 100% stocks, which hopefully you're not.
And if you are, you definitely need to sell some.
Right. But if you're just talking about the bond allocation so you don't hurt yourself, that physical, emotional pain of selling this winter, you don't have to do it. Just talk about the bonds because you ain't made anything on them anyway.
That's right.
So let's look at those and what happens if the market's even for a while, up, down. Also, if interest rates go up, what happens?
And do it before bonds go up.
That's right. And I want to thank everyone for listening to the Common Sense Investing Show today. Remember, if you have any questions, you'd like a copy of our white paper from Roger Ibbotson. My mind just went blank. Call us at 972-715-2424. Again, 972-715-2424. You can always go to our website, ilovemyretirement.com. There's some great videos on there. Go ahead and check it out. I'm Victor McClure for Guy Allett. We always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.